2023 was a transformative year for HIMS and HERS. Revenue increased 65% year over year to $872 million. Over 1.5 million subscribers were on the platform at the end of 2023, representing a year-over-year increase of 48%. I'm incredibly proud of our organization's ability to scale our platform efficiently and deliver our first quarter of positive net income on the one-year anniversary of our first quarter of positive adjusted EBITDA. Today, our efforts are focused on ensuring that customers have a delightful experience across 5 core specialties: sexual health, men's and women's dermatology, mental health, and weight loss, which we're excited to launch in the fourth quarter. Personalized offerings, which have now been adopted by over 30% of subscribers on the platform as of year-end, have allowed these specialties to continue to scale at a rapid rate through 2023. As we continue to see increasingly rapid adoption of personalized approaches across newer specialties such as HERS dermatology, mental health, and weight loss, we are confident that each of these specialties has the ability to deliver more than $100 million of revenue in 2025. These factors provide us with line of sight to achieve our 2025 targets of $1.2 billion of revenue and $100 million of EBITDA 1 year early. We are also tracking toward our first year of positive net income in 2024. Over 85% of orders going through affiliated pharmacies provides us greater ability to realize the benefits of scale and ultimately pass value back to consumers in a way that is beneficial for our users and accretive to HIMS and HERS.
Our fourth quarter results are a great example of the intersection of great strategy and strong execution. Revenue grew 47% year over year to $246.6 million, driven primarily by the ongoing expansion of our subscriber base. Our shift toward affiliated pharmacies allowed us to offset the margin impact of strategic pricing actions implemented in 2023. Even more exciting is that they provide a platform to unlock efficiencies that will enable us to provide a better consumer experience at even more attractive price points. Gross margins expanded almost 4 points year over year in both the fourth quarter and across the full year to 83% and 82% respectively, as we were able to identify and capture these efficiencies. Disciplined growth and rigorous cost management are resulting in step change improvements in profitability. Adjusted EBITDA increased 68% quarter over quarter in the fourth quarter to almost $21 million. This represents more than a 5x increase relative to the fourth quarter of last year, which was our first quarter of positive adjusted EBITDA. Our expectation is that we will achieve adjusted EBITDA margins of at least low to mid-teens by 2027 and be within our long-term margin range no later than 2030. Our expectation is that marketing as a percentage of revenue will be in the mid-30s to low 40s by 2030. Our business is based on a recurring revenue model, and the majority of marketing spend goes towards the acquisition of new users. As our user base continues to mature and the average tenure of users on the platform increases, our expectation is that we will gain leverage.
I think we mentioned HERS dermatology, north of 70% of people are adopting those types of personalized treatments. And with our newest category, weight loss, nearly 100% of people are adopting those personalized treatments. So we think that that type of an offering will result in a much stickier relationship long term. And so I think given the size of those markets, which are absolutely enormous, as we know, it just gives us a tremendous amount of conviction that those emerging categories will be meaningful contributors to growth in the long term. But even in the not too distant future, we believe those to be able to contribute $100 million plus.
As we look to the affiliated pharmacies, as mentioned, over time, we view gross margins going to more of the mid to high 70s. It is probably likely going to take us a few years to get there just because in the affiliated pharmacies, there are opportunities that can drive higher margins. That unlocks the ability to leverage our balance sheet to drive greater efficiencies as well. The vast majority of our spend actually goes towards the acquisition of new customers. And so as a result, as we continue to build a larger and larger base of existing users that are tenured on the platform, that inherently results in more leverage. And so as a result of that, that gives us the conviction to start to call the fact that we'll even receive leverage as early this year. Yes, I think we're very excited by the adoption of personalized products as we look into 2024. Our belief is that as a greater share of users shift to those products, retention on the platform will be stickier than historically has. And really what we've seen in the early signals is as we put many of the personalized offerings and longer duration subscriptions at more attractive price points, what drove the ability to break even last year was primarily around new users switching and a different composition mix. So the combination of those things gives us confidence, that retention will continue to improve throughout 2024. As a result of that, some of that is reflected into the stronger guide. We are seeing, as a result of some of the pricing changes that we made in Q2, a greater share of users opting for subscriptions that are longer duration in nature. And then there's from quarter to quarter there is adjustments that happen in the overall product mix. But we would say just a lot of the movements that we're seeing are tend to be within the course of normal, and so it's been relatively stable over the last couple quarters.